Hi everybody, and a very good morning to you all. Welcome to this morning's structured CPD session. For those who haven't virtually met me before, my name is Marie Waits and I'm a Managing Director here at Quantuma. And on behalf of our parent company, the K3 Capital Group, I'm also responsible for the K3 Hub, which is a member network for professional advisors developed by us and other companies within the K3 Capital Group. Since we launched in the spring of 2021, over 2,300 like-minded professionals across the country have joined our network, through which they've accessed a range of CPD and training sessions similar to today's event and referral fees for certain types of work referred into our group. So today we have a 3-hour CPD session, which is tax risks for non-tax specialists. Before I introduce you to our speaker, I've got a few pieces of housekeeping for you. So I'm often asked this, but we are recording today's session and it will be on the K3 Hub website at some point next week. Q&A function is open. Please do feel free to ask questions as we go along. If you can, please use the Q&A function rather than the chat to ask your questions. We've got some slides that we'll be sharing with you in the chat, and we'll be sharing those periodically so that we don't get mixed up between requests for slides and questions. If I can just direct you to the Q&A for your questions for Jeremy today. We will be having a couple of breaks this morning. They'll be on each of the hours, and we have got a poll running, so we've just got 3 quick questions, but rest assured your responses are anonymous. Just covering off a few things about the K3 Hub. So this is our last CPD webinar of the year. However, I'm delighted to let you know that we already have 4 sessions confirmed for 2023. We'll be starting again in February so that you've got time to get over your tax season, with the first session up being VAT common errors and misconceptions. We'll be in touch in the new year about that one. Anyway, on to today's session. So I'm very pleased to be able to introduce you to our speaker, Jeremy Mindell. I'm sure many of you already know Jeremy, but for those that don't, Jeremy has been lecturing in taxation for over 20 years and is an extremely accomplished speaker. And for those that know Quantuma well, he's been lecturing for us for quite a long time. Jeremy covers issues related to tax, pensions, share schemes and remuneration. And he's also one of a few individuals in the country who is a qualified chartered tax advisor and also holds a certificate from the CIPD. Today, his session will broadly cover employment versus self-employment and IR35 status issues, COVID payments, the scope of PAYE, deductible and non-deductible expenses, and making tax digital. So all that remains for me to say is I hope that you enjoyed today's session, and we'll very much look forward to seeing you again next year. Jeremy.
Thank you very much, Marie. Thank you for the introduction. So what I'm looking at today is, as said, tax risks for non-tax specialists. So it's a more general look. What I thought I would do first of all is let's take the first polling question. So in the next budget, do you think the Chancellor will increase taxes, decrease taxes, keep them about the same? And the next budget is due in March. So please vote away now, and put your vote in. You've got about 30 seconds to think about it. So 46% said increase taxes, 4%, that is only 2 people, said decrease taxes, and keep them about the same was half the people, 50%. So half the people thinking he'll either keep it the same, just obviously under half think he'll increase, and the other half think or a very small percentage think he'll decrease. Funny enough, I'm actually probably with I don't think he'll be increasing taxes again. I think that's the lot until the election, unless something goes disastrously wrong, and one cannot overlook that possibility. But I'm actually more on the optimistic side. I think he'll keep taxes the same, or he might even slightly decrease them or announce decreases, remembering there's an election due in about 2 years' time. So interesting. But obviously, in terms of those thinking about increasing taxes, one way of increasing taxes without actually increasing rates is to improve HMRC's collection of taxes, both assessment and collection. And into that comes quite a lot of risk for different people and companies in terms of what you are looking to achieve on that basis. I'm not going to do the next polling question for a while, but let me talk about very briefly. I've been asked to introduce myself. So I've got a background in personal tax and share schemes, Big Four accountancy, senior manager. I was an in-house advisor to Henderson Global Investors and looked at SIPs and share schemes. I looked at the financial education, really tried to promote that, and I'm the head judge in the IFS ProShare Award. So a variety of elements that I've looked at over a long career. So what are the risk areas that we're looking at? Well, income tax. The biggest revenue raiser is income tax. So HMRC, His Majesty's Revenue and Customs, so we now must get used to calling it, always are looking at the income tax base, how you can collect more money from existing customers, as they like to call it, and ensure that the compliance is done at an acceptable level. National insurance, which is often the second biggest revenue raiser, again linked to income tax, but with some interesting differences. Corporation tax, we hear a lot about it, and of course it's going up from April from 19 to 25% for companies which effectively have profits above £50,000. You'll pay a marginal rate of potentially even more than 25%. So always an area of interest. International employment tax, it's an area which causes a lot of problems and challenges in terms of the technical details of the interaction between the UK and foreign tax systems. Pay-as-you-earn checks, where they're looking at the administration of pay-as-you-earn, the requirement to withhold tax and normally national insurance from payments made to employees, as well as COVID payments. In terms of pay-as-you-earn, clearly you need to know whether pay-as-you-earn is in scope, and for that you're looking at employed versus self-employed people. The regular issues that come up time and time again, as I indicated, was employment versus self-employment. COVID payments, probably, as we know, a temporary element, but something which you need to be aware of, because there's quite a lot of pressure being put on the tax authorities to reclaim the furlough payments that were made wrongly and the overclaims. And there have been a number of arrests and indeed prosecutions for people who have overclaimed COVID payments. Now, not the accidental overpayments, but generally the sort of mass marketed fraud which has happened from time to time in terms of both the furloughing payments and indeed the bounce back loans, as well as the self-employed income support schemes. So there's quite a lot of pressure on the government to and from the government onto HMRC to take strong measures to recover those payments. We'll look a bit at the scope of pay-as-you-earn, which is the primary tool for collecting income tax in terms of the vast majority of people who are employees. The UK system depends on withholding taxes and automatic payments of taxes, and indeed about 95 to 96% of all 95 to 96% of all taxes require no intervention by HMRC at all. They come in automatically, which is sort of a tribute to the culture of compliance that there is within the UK tax-paying system, but also this is a system that has been constructed over 2 decades, and therefore is a sort of well-worn and trusted system. And although we may have complaints about different elements of the tax system, it generally works in bringing in the revenues that the government expects. Indeed, our tax gap between what HMRC thinks it should be collecting and what it is collecting is one of the smallest in the world. Then, as I say, national insurance, there are differences, and people get that, tend to underestimate the differences between income tax and national insurance. We'll talk about deductible, non-deductible expenses. People have the misapprehension that you can claim any expenses which relate to your work or business as deductible, and sadly that is not true. I'll talk a bit about making tax digital. Some of you will have already encountered that. Others have that joy still to come, as making tax digital for income tax purposes starts on the 1st of April 2024. We then have VAT, value added tax. I'm going to talk a bit about that and some of the pressure points, and then a little bit on international tax compliance. So what do you need to prioritize? Because you could spend all your time looking at tax risks, but frankly, that is not commercial. It is not something that, unless you are a full-time in-house tax manager working in-house for a company, you're not going to be looking at a company's tax risk the whole time. There are other elements that you need to think about. And in terms of what to prioritize, you're going to look at what is material, what affects other areas of the business. So in other words, do you have a tax which or a tax position which affects more than one tax? Is it going to be of the same materiality? Is it going to be a large enough area to be concerned about? Excuse me. What about the effect on the company's reputation if things go wrong, particularly consumer facing companies, and then or companies that are bidding for government contracts? They need to be particularly concerned about their reputation. And then finally, is the risk controllable? In that area, what you tend to use are things like heat maps. So you would look at a very simple traffic light system of red, amber, green. So green are areas that you don't need to worry about. You review on an annual basis and you tick the box to say we don't think that that area causes us concern, it's well controlled, or it's not material. Amber ones which have some concern but don't require immediate action and may require a watching brief and a more rigorous review. And then red are the areas which are seriously wrong, and on that basis, if they're seriously wrong, you're going to have to do something about them pretty quickly before HMRC does it for you. And the heat maps will be dependent on the size of the issue, the measures taken to deal with them, and previous audits and corrective actions that you've taken. So if, for example, let's say you're a non-specialist in tax and you sit doing the finance function, so tax may come within part of the area of your responsibility, but you're not looking at that most of the time. You have other pressing issues. How do you prioritize? Well, you look at a heat map, and as I say, you look at the size of the issues, the measures taken to deal with it and control it. And if you've had previous audits, how have they come out and what have been any corrective actions? In terms of good foundations give you a good outcome, clearly the combination of accurate records, qualified, experienced staff, the culture of compliance itself. So in other words, when I talk about the culture of compliance, that it becomes second nature to do certain actions. And if you think about it, a tax and finance function will almost always be a small number of people within a company. Getting a culture of compliance means that other departments think about the effect that they have in terms of accounting and tax, and that if they think about it, the sales force, the strategic part of the business, the company secretarial, the management, whether it is senior or middle management, think about the effect of what they're doing and think, there may be a tax implication. That's a good way of getting a culture of compliance. Then, of course, there is the tax compliance itself. And then finally, at the top, a strong financial strategy. Let me look at the scope of tax compliance. So let's give an example of a small business. So Kirsty has set up a jewelry business which has specialized in jewelry from West Africa as well as the Middle East, which she imports and finishes in a workshop in the UK. She has turnover of £150,000, expenses of £50,000, including for help in the workshop, and she takes £70,000 from the business for her living and other expenses. So when I look at that, what are the tax aspects? Well, they are quite substantial. If Kirsty is running as a company, there will be corporation tax that she'll need to deal with. She's got a workshop, so she's going to have to look at business rates on that basis. She's taking money, and therefore there will be income tax and national insurance on that basis to worry about. Not only her income tax and national insurance position, but as I pointed out, she's got a helper in the workshop. She's got to work out the status of that person. Is that person or people employees, or are they self-employed? And on that basis, does she need to set up a payroll system? And then finally, on this slide, VAT, her turnover, taxable turnover, is above £85,000, and therefore on that basis, VAT would be in point on that basis. Other elements that you need to think about would be customs duties. Remember, she's importing jewellery from outside the European Union, so therefore on jewellery parts and components. So she's going to have to look at customs duties on those elements, the raw materials that she is and jewellery that she's importing from outside the UK. And of course, because she is VAT registered, she needs to be concerned about making tax digital, i.e. having her accounts on a digital format, or at least in terms of preparing the VAT return, that is done in a format which is digitally compatible. She can put stuff on a spreadsheet, take that onto bridging software, and from that bridging software, she can then create the VAT return that she's likely to have to do on an annual basis with quarterly payment installments for that. I mean, she has a low enough turnover that she could do annual VAT statements with quarterly VAT payments, noting that she may well have not just customs duties on the amounts that she's importing from West Africa, but she may also have VAT on top to pay as input tax, which she can set against her sales that she makes to customers. In other words, you tot up what she pays in VAT, you tot up what she charges in VAT, and it's only the net amount that would go to HMRC. If you do a quarterly VAT amount, and I'll talk about that a little bit later on, then HMRC estimate the VAT payments that need to be made on a quarterly basis, and then there is an annual reconciliation. So the sort of questions to ask would be, Is she VAT registered? Is it an unincorporated company? Unincorporated business, in which case she is taxed on the profits that she makes, which she puts on a tax return? Or has she got a company and draws salary from it, in which case there's pay as you earn? A company will require a corporation tax return, a business does not. Pay as you earn on the pay for the helper, again, you're going to look at their status. If it's a company, there would be pay as you earn on the salary. And if she pays money out of profits, there would be dividends as well. So the question then arises, looking at Kirsty's circumstances, is do I incorporate? What are the pros and cons of incorporation? And when I look at that, reminder of the different elements there. If I am unincorporated, it's just a simple relationship between the customer and the trader. So you are the trader, you are trading with customers and with suppliers, and you can trade, you don't need to have a company, and you can trade off your own initiative. And if you make money, then you pay tax on the profits. The contrast is where you've got you, the company, and the customer. So the company is a separate legal entity within that position. And therefore, you are there are two elements of tax. One is at the company level based on the company's profits. And the second element would be on the amounts that the company distribute to you. So in the previous example, you're getting all the money in and you pay tax personally on the profits that are made, even if you reinvest them in your business. Whereas here, you are only individually taxed as an individual on the amounts that you withdraw from the company, either in the form of salary or in the form of dividends. The company itself is subject separately to corporation tax before any dividends are paid. So let's look at the advantages and disadvantages. So if I incorporate, the advantages are that there are possible tax savings, particularly when one involves other people in the business, such as spouses or children. Incorporation can save money. There is an easier future potential transfer of partial ownership interest. You create shares and you can transfer a part of the business much more easily. There also, the perceived status of the business is a bit different. Some companies only like to deal with other companies, and that can be a particular issue in certain industries. There's also control over how much income the directors or shareholders are taxable on. So just as a reminder, because of the phase down of the personal allowance, in other words, for every £2 of income, taxable income you have above £100,000, you lose £1 of personal allowance. Effectively, the tax rate between £100,000 and £125,140 is actually at 60%. So if, for example, your income is at, say, £97,000, you might think twice about wanting further income that is going to be taxed at effectively a marginal rate of 60% or so. So this is one way of controlling your income. If you're a trader, your income is recognized on the basis of when you bill and when your customers pay, depending on whether you're on a cash or an accruals basis, i.e. whether you recognize the income when paid or recognize it when it is due. But effectively, an unincorporated business is subject to significant volatilities on that basis, and I think that that is definitely an issue that you need to think about. Whereas a company, you can, if you're the owner of a company, you can actually manage your income flows, maybe even them out between different tax years, particularly taking into account the high marginal rates of tax over £100,000. And indeed, if you are, say, earning less, between £50,000 and £60,000, but are in receipt of child benefit, there is a high effective marginal rate of tax because of the phase out of child benefit between £50,000 and £60,000. Avoidance or mitigation of NIC by taking a suitable salary topped up by dividends. That is always possible. So what you're looking at there is taking a salary of, say, £12,500 or so, and then above that, just paying dividends, which are not subject to national insurance contributions, and ability for employer pension contributions up to the annual allowance, which is £40,000. So the ability for a company to make a contribution of up to, say, £40,000 per annum in terms of the pension without having to have earnings to justify it. What are the negatives on that? Well, the need and cost. You've got to prepare accounts for shareholders and file accounts with the registrar. Annual returns are also required. Fines for not complying with company law. The Companies Act 2006 is one of the largest pieces of legislation ever passed by Parliament. And again, important to look at, if you're a director, you need to comply with it. And if you do not comply with various elements, then either HMRC or can issue you with a personal liability notice for taxes unpaid. So if the company goes into liquidation with unpaid taxes, it is possible that the directors would be held personally responsible. That is particularly the case where the company has acted as a withholding agent, where effectively the taxes paid are not the company's, they are withholding it on behalf of other people. 3 examples spring to mind: pay as you earn, which you deduct the tax from your employees and you act as paymaster, or the company acts as paymaster and pays it over to HMRC. If that is not paid over to HMRC, the directors can become personally liable. The same is true of VAT, where you charge VAT to a customer. On that basis, let's say I have a mat here and I charge £1 for the mat. On that basis, if I charge £1 for the mat, within that there is an element of VAT. The VAT that is charged needs to go to HMRC. I can deduct any costs or VAT costs that I've had in making the mat, but the net amount needs to go. If the net amount is 10p, for example, if I don't pay that 10p, I become potentially liable for that on that basis. Okay. So, important to think about company law, need and cost to file a CT 600 on top of a self-assessment tax return and accounts in an IXBRL format. IXBRL, so when you do accounts, you have to do IXBRL, which tags those accounts effectively to the corporation tax return. What does it do? It makes it easier for HMRC to analyze your accounts and see whether there is an element that needs to be investigated if there's an inconsistency. And potential future double tax charge if the company has chargeable assets to get the cash into the hands of the shareholder. So if I sell a valuable asset like a piece of machinery, for example, and there's a gain on it, the company pays tax on the gain. That money then sits in the company. If the shareholder wants to get hold of it, then the company pays out a dividend and there is tax on the individual shareholder. So a double charge to tax. So in terms of summarizing the pros and cons of incorporation versus limited liability, so unincorporated. Incorporation may have limited liability, may protect directors, but don't assume, particularly in terms of tax compliance, that that protection is absolute. There's quite a possibility that if a company goes broke without paying its taxes, that the directors end up with a personal liability notice. Unincorporated has full liabilities. Credibility could be, if you're a company, there may be greater credibility. It is important to understand that it is a separate entity for legal and tax purposes, required to do annual returns, required to do a corporation tax return. If you pay yourself, even as a director of the company, anything, there is pay as you earn on that, and there would also be dividends. In terms of unincorporated, I talked about the liabilities. The individuals are taxed on their profits, so they just need to fill in the self-assessment tax return. Cash flow, there may be some advantage, particularly at the beginning, in terms of having only to pay tax on profits in twice a year, January and July. There are less returns to do, and you can claim tax relief on losses. So if you make losses in the first few years of trading, you can carry that back and use that against pre-trading income. When you were, say, you've moved from being employed to being owning your own business. Let's say you make losses in the first couple of years, you can actually carry them back again and use them against the income you had pre the business, which might be against your pay-as-you-earn liabilities or your employment income, and therefore generate refunds in prior years. So that's an important element, that quite often loss-making enterprises start off as being unincorporated, and only when they're really established and making profits do you incorporate them, because it's much easier to get relief for losses in the earlier years of a business if you are unincorporated. So if I look at what I'm thinking about, you have an idea, it's a business plan, and you'll probably do cash flows as well. So you've got an idea, you turn it into a business plan, and then you think about your cash flows. You need to notify HMRC of the existence of the business, register for VAT, and also register for corporation tax. So register for VAT if your taxable turnover goes above £85,000, and register for corporation tax if you are a company. So first element required in all cases. Second element, if your taxable turnover goes above £85,000. And the third element is if you form a company. Other elements, clearly, if you are a company and you're paying individuals, you need to register as an employer, even if you're just paying yourself. Whereas if you're a sole trader, then you haven't got any pay as you earn if you're just a sole trader being taxed on your profits. Clearly need to register for national insurance in both cases, because you'll have a primary national insurance to pay if payments are made to employees or directors, and secondary national insurance will be paid by the company. If you are self-employed, you pay Class 2 national insurance, which is a flat amount, as well as Class 4 national insurance, which is based on a percentage of your profits. And if you haven't done so, you'll almost certainly need to register for self-assessment. It clearly will need to do so as a self-employed person, because you'll need to do annual tax returns. If you're a director of a company, it is possible that you will have to do tax returns as well. In terms of registering for HMRC taxes, what you do is you go onto the HMRC website and you just put in a search button for register for HMRC taxes, and this page will come up. And then what you're looking at is the possibilities of what you need to register for. That could be, if you're self-employed, self-assessment, including the flat class 2 national insurance contributions, as I said, corporation tax for companies, pay as you earn for employers, which could be either as self-employed if you engage someone else, or if it's a company, any payments would be subject to pay as you earn. And as I said, VAT on the register, VAT if your turnover goes above £85,000. The note, the thing that I would note for that is that this is all on an interactive page within the HMRC website. What are the important figures for this year? Well, they keep on changing, but personal allowance 12,570. We better get used to that. It was the same figure last year, and it's supposed to be the same figure till 2028. Basic rate of tax unchanged at 20%. National insurance class 1 primary, you might have noticed that you've got a bit more take-home pay this month as an employee because the rate fell from 13.25% to 12% on the 6th of November. So the paycheck you've just received should have that basis on it. National insurance secondary 13.8%. Class 2 national insurance £3.5. National insurance class 4 9% on your profits between 12,570 and 5270. The self-employed pay 9%, so that's cheaper than either the secondary national insurance, which would normally be paid by a company, or the primary NIC that would normally be paid by an individual. VAT threshold, as I said, £85,000, and corporation tax rate for this year 19%, going up, as I say, for companies with profits above £50,000 next year. Also, a quick reminder, because people get this confused, what is taxable income? So taxable income would be money from the sale of goods, money from the sale of services, money from the sale of licenses and image rights, interest received, all those sorts of elements of trading activities and indeed investment activities would be taxable income. What is not taxable income would be loans that you receive. So if I receive a loan and put money into a business, that is not included in taxable income. Gifts for no consideration would again not be taxable income. And investments into the business, as opposed to customers paying for things, investments into the business again is not taxable income. So one of the areas that I talked about was, in the example I gave, was Kirsty in her workshop deciding that she needed someone else to help assemble the jewellery and deal with things when she's off meeting customers and suppliers. So the question comes up, are the people employed or self-employed? So in terms of taking on staff, the question is, what is the position regarding, do they provide their own equipment? Do they advertise on their for themselves or for their own business or for their employer? How are they in business on their own account? Do they negotiate rates? So self-employed people tell you what they're going to charge. You might negotiate that, but they set the rates generally. And is there discretion over taking work? So in other words, is there what we call mutuality of obligation, that as an employee, I'm expected to turn up for work, and as an employer, you are expected to give me work. That is known as mutuality of obligation, and that is seen as quite key in this area. When you look at, for example, recent cases on television presenters, for example, they have strict contracts saying that they have to appear a certain number of times a year. There is strict control on the content of their programs, and generally speaking, that they are seen as being employees. So if I take examples, clearly there are ones which come with grey areas. If I have somebody who comes in once in a while to help with my workshop, the question would be, is that casual staff, or is that someone who is self-employed? Now, clearly, the longer, the greater the proportion of the week that they are working in my workshop, the more likely it is what we call a master-servant relationship, i.e., I tell them when to come in, they expect to be paid, rather than a situation where on an ad hoc basis, I get them to come in and they might say yes or no, I can't do it today. I've got other work to do. Maybe these people are on business on their own account and are therefore working for in a number of different jobs and activities. So the more independence that the person below has, the more likely it is that they will be self-employed. Take an example. Let's say I have somebody working in that jewelry workshop 5 days a week. They are likely to be employed. Contrast that with somebody, you know, some of my machinery needs servicing, so I call someone up to service the machinery or repair it. Those people are definitely self-employed. The more you've got a specific job of doing specific tasks, and when you finish those tasks, you know, you get paid based on finishing the task rather than the time taken, the more likely you are to be seen as self-employed. What do I mean by that? So if you take a lot of jobs, let's say I need my chimney swept, which I think I do actually, need to phone them up about that. They quote me the rate for sweeping my chimney, tell me when they can come, bring all the machinery, and there's quite a lot of machinery nowadays for sweeping chimneys, such as, you know, the brushes, the vacuum cleaners, and so on that they use for it. So they come along, they use the equipment, and then they go. I do not have an employment relationship with them. There's no requirement for me to phone up that particular chimney sweep and use them. I could use any chimney sweep, although they're in quite a lot of demand at the moment. And I don't provide any of the equipment. And also, the quicker and more efficiently they do it, the more profits they can make. They are paid for sweeping the chimneys if they organize a situation where they are in my area for a particular day and therefore can see more customers with less travel costs. They are controlling their expenses, but they're also managing their work to maximize their income. So variability of income and the ability to control your income or increase it and control your expenses is quite an interesting indicator of self-employment. So the testing characteristics that you might look at would be integration. Are you an integral part of the business? More likely to be an employee. To what extent are you controlled by the business in terms of your hours and conditions? More likely to be an employee, the more time you spend. Do you have economic autonomy? What are the contractual terms? You know, what does the contract say? That is not the be all and end all, but you at least start with the contractual terms which help determine employment status. Mutuality of obligation, as I said, what obligation do I have to give you work and what obligation do you have to accept it? Who puts the capital into the business? Is it the engager or is it the subcontractor? And then finally, how are you represented in the business? Contrasting treatment, as I say, Self-employed, it's only 9% NIC class 4, and that is only up to 50, up to the upper earnings limit of £50,270. Class 2, £3.15 per week. Whereas with the employed, it's a much bigger bill, 12% primary and 13.8% secondary, with no limitation on the secondary NI. It goes on ad infinitum, whereas at least both the 12% primary NIC and the class 4 are at those figures until you get to 5270, and then they drop to 2% national insurance. The other element that is different is that the expenses are wholly and exclusively, that is all that is required to qualify for deductible expenses for the self-employed, whereas for the employed, it's bigger. It is expenses wholly, exclusively, and necessarily in the performance of their duties, which is if you think about it, a much more restrictive element. Not only are they wholly and exclusively, but now you've got this necessary test. Were they necessary for the performance of the duties? And also in the performance of the duties has a sort of time relationship as well on that basis. In other elements of contrasting treatment, the self-employed, there is self-assessment on the profits. So you fill in your tax return once a year. You may well have a payment on account required in July, or 2 payments on account, July and January, and then the balancing payment with the filing of the return. Whereas with pay-as-you-earn, that is payable, assessed on a monthly basis, and for small companies, payable potentially on a quarterly basis if the pay-as-you-earn liability is very small, or potentially you are looking at a monthly basis of pay-as-you-earn for larger companies. So the tax month runs from the 6th of each month to the 5th of the following month, like the tax year. So the first month is the 6th of April to the 5th of May, and the pay-as-you-earn will be due by the 19th. What do you need to do if you're operating pay-as-you-earn? Something that I was doing last night, for example, was that for the period from the 6th of November to the 5th of December, we were doing the real-time information returns on that basis. That shows the pay-as-you-earn and national insurance due for that month. And if it's due on a monthly basis, it will need to be paid by the 19th of December of this month. So you look at the pay month. The pay month starts on the 6th of that month, ends on the 5th of the following month. So the November period ends on the 5th of December. You need to have done your real-time information return on the salaries paid and calculate the tax and national insurance, and that pay-as-you-earn needs to be paid by the 19th of that month. If you're paying it electronically, I think you might have till the 22nd to pay it. What is important about that? Well, if you are late with your real-time information return, there can be a penalty. And of course, if you're late with your pay-as-you-earn, there can also be interest and penalties. Linked to that is, of course, IR35. So what happens if you use a personal service company? In other words, instead of me as Jeremy Mindell providing services directly to lecturing companies, I do it through my company, Primondale Limited in my case, a personal service company. Generally speaking, you're providing your labor only, you're not and services, you're not providing products on that basis. And therefore, the same tests effectively apply, because what you say in terms of IR35 is a very important question, which is if you didn't have the personal service company in between you and the end user, would it be a relationship of employment? So you can go through all the categories and the issues I've had before. And if I say, well, actually, the agreement is between my personal service company and the end user. So let's say I provide, tax lecturing services to XYZ Tax Lecturing Company Limited. What there is I would say, well, look, there's an agreement between Primondale and Tax Services Lecturing Limited. And therefore the dispute is between them, and Primondale should be able to receive payments gross from Tax Lecturing Limited. What IR35 does is say, well, if there wasn't Primondale, if you had a direct relationship with, you were just providing services to Tax Services Lecturing Limited, on that basis, would you be seen as an employee? So exactly the same tests as we looked at before. If the answer is yes, then you would end up with with an IR35 charge. It would be seen as relevant employment, a relevant engagement, I should say, and therefore the end user would have to deduct, the end client, I should say, in this case is Tax Services XYZ Limited, would need to operate pay-as-you-earn and national insurance on the payments it makes to my company. They use the same tests on employed versus self-employed. You can go onto the HMRC website and look at check your employment status tool. You enter the information, it'll come out with a view about whether you are employed or self-employed, whether you're within the scope of IR35 or not. And therefore, on that basis, if you use the CES tool, that should be something that you might have to show to your customers to show that they don't need to operate pay-as-you-earn and national insurance on the earnings which they give to you, on the payments they give to you. It had been proposed that this responsibility would fall back to the personal service company, but that position, like many others, was reversed in the subsequent statements, and that responsibility remains if it's in the public sector, something like a health authority. They need to determine that point, and they have the responsibility for operating tax withholding, and that will not change in any time soon. And the same is true with large and medium-sized companies. They have the responsibility for determining IR35 status. So there's normally some sort of conversation between the contractor and the company. Often the company will insist on a CEST form being filled out by the contractor, being submitted to the company, and the company will look at the conclusions of that. Okay. Not had any. Oh, I've got one Q&A. What happens with IR35 for small companies? So with IR35 for small companies, it is still the responsibility of the personal service company to determine whether they are within the ambit of IR35. Let's say I provide services to a health authority, but also to a small company as well. In terms of the health authority will determine and be responsible for IR35. With a small company, it is my personal service company, therefore me, who has to determine whether it's within the ambit of IR35. Okay, so small companies, if the end user is a small company, not the personal service company, but if the end user is a small company, it's up to the personal service company to determine the status. So as I say, I could have a situation where, for example, I deal with large lecturing companies, and those large lecturing companies need to determine whether the payments are within the scope of IR35. If I deal with a small concern, a small lecturing company, then I have to determine as the director of my PSC if I fall within IR35 or not. Hope that answers the question. So national living wage, note that this is an area of increasing concern. In other words, HMRC is put under pressure to ensure that there is proper policing of this area. To ensure that the wages are paid to individuals who may be suffering from a cost of living squeeze. Secondly, because the more wages that are paid by the company or employer, the lower that the individual's demands are on the universal credit system. So indeed, as the national living wage, which is for 23-year-olds, go up, or the national minimum wage for under 23s goes up, the less claims there are, or the less quantum of claims there are for universal credit. So it is in the government's interest, for a number of reasons, to ensure that this is enforced. It also, as Winston Churchill said all those years ago, wages councils and regulation of wages protect the good companies from bad companies, exploitative companies, undercutting them. So generally speaking, this has become a feature over the past 15 years, but there's been a real substantial increase in the national living wage, and the national minimum wage normally increases well above the rate of inflation. What can go wrong with these elements? Well, what can go wrong would be time recording. So remember, commuting time does not need to be included in the hourly rate. But if you're traveling from your place of work to a client or to a supplier or on business, that needs to be included. If you have to spend 15 minutes in security checks to get into your premises, or even longer, that needs to be included in your timing. If the manager calls you for a pre-work meeting in advance that takes place every Monday, then that needs to be included in the time. So time recording, which could be security, could be travel, excluding, of course, commuting costs, but effectively any business travel needs to be included. And that has the interesting element because business travel is normally deductible for tax purposes, but does need to be included in terms of the calculation of the national minimum wage. If you include tips at a restaurant, that is wrong. You have to pay people, including waitering staff, the national living wage, and you cannot use the tips to top up the national living wage, or rather to be included. They have to be additional. So a waiter who is over 23 would need to be paid £10.42 per hour from April and gets the tips on top. I talked about checks, so security time, but it could be any other time which you require employees to work, and the wrong age of employees. So, if you get the wrong age, you'll get the wrong thresholds on that basis. Okay, we're at 10 o'clock. Let's take about a 9-minute break. So we'll be back at 10:10. Two questions before I carry on. When setting levels for a client with his own company, we now have different starting points for employee and employer NIC. Yes, you do. So it's still in the £9,000 pound mark for the employee NIC, a lower threshold, and employee NIC starts at will it will be from next year. 12,570 will be the rate. Remember, they increased the threshold partway through the year, but the full effect of that will be 12,570. So yes, there is a differential between the employer and employee rate on that basis. So yes, that is true. And then if we are trying to minimize the charges to him but protect his pension rights, will he get pension credits if only the employer makes NI payments? Again, probably the answer will be yes, because you have to look. Once you go, there are two concepts. One is what is called the lower earnings limit. You need to be above that lower earnings limit in order to get pension credits. And that lower earnings limit is a figure, I don't know it exactly, you can look it up, but it is a lower figure than the primary threshold. The primary threshold is the threshold at which you pay national insurance, but you could have a situation where you are below the primary threshold, below 12,570, but high enough in order to get pension credits. So important to look at that. And then, of course, there is the ability to top up your entitlement, even if you haven't got sufficient earnings, by paying class 2 or potentially class 3 national insurance contributions. So the voluntary contribution, class 3 is about £15 something a week. Class 3, that's class 3 voluntary, or class 2 if you're self-employed. So yes, it's quite complex, but what you need to look at is the lower earnings limit for employees in order to get pension credits. And in terms of if you're not able to get those, whether the client should pay voluntary contributions. Okay. Right, so I shall carry on. Tax conditionality. So one of the areas of compliance that has become considerably more hazardous is where you are in a business which HMRC thinks is prone to having cash which sort of disappears and is never recorded. What are we looking at there? Well, from April of this year in England and Wales, renewal of licenses to drive taxis and private hire vehicles, to operate a private hire vehicle business or deal in scrap metal will only be given if the person applying for that license can show that they've completed a tax check with HMRC. And applicants will need to complete a basic online check to confirm that they are registered for tax if they need to be. Online checking service will help clients complete the tax check and pass on confirmation to a licensing body once the check is complete. So what you're seeing more is, and you've seen it in the construction industry scheme, that you can't get the CIS certificate for gross payments. In other words, being able to receive payments gross without deduction of tax. That can only be, you only get a CIS 5 or CIS 6 if your tax compliance is in order. And HMRC has seen this through a number of cases like JP Witter as a very useful tool to ensure that companies and individuals are compliant. So they have extended this to a number of different areas where they think that tax evasion is more prevalent, and said that getting a license will require a tax check with HMRC. And that's a good example of compliance and public sector licenses coming together on that basis. In terms of registration, registering for self-employment, everyone applying to register as self-employed must now obtain a national insurance number before registering by applying online. Obviously, generally speaking, British citizens are given them automatically on their 16th birthday or around their 16th birthday. You used to be given a national insurance card, but they don't do that anymore. And individuals who registered as self-employed without a national insurance number must obtain one. So that is particularly people who've come into the country and never got a national insurance number. And then size matters. So I'm going to move on to talk a little bit more about employment taxes on that basis. And employment taxes are important because they are expensive. So when we look at a basic rate taxpayer, employer gives £1,000 to employee, the employee pays £450 in tax if they're at the top rate. The top rate £450, employee NI 2% £20, the employer NI is £130. So the total costs of this are £138 of secondary national insurance. So that's on the top £1,000 that's given. So if I gave a bonus of £1,000 to a person who's already in the top rate, remembering, of course, that the top rate threshold is dropping from £150,000 to £125,140. So next year it'll just be once you've phased out your personal allowance, so you've paid your 60% tax, you then have the joy of going down not to 40% but to 45%. So more people are going to be in this position. So of my £1,000, net to the employee is £530, but actually the company has paid £1,138 in order for me to enjoy £530. Even so, that is a 53% leakage on that basis. I put 1138 in there. 53.42% has leaked away to HMRC, leaving me £530 less left. So 47% of what there is. So I get about 47% of what the employer has put into the salary costs once I take into account secondary national insurance contributions. And even for basic raters, this is quite expensive. If we look at this, £1,000 given to the employee, notice it's £200 of income tax, employee NI of £120, and that's based on the new November rates. Rates post on the 6th of November and post that point. Employer NI £138. Total costs for the employee is £320, leaving them £680, and the employer is still paying 13.8% secondary national insurance. So on that basis, it's still expensive for what I call Tommy Atkins, the ordinary person who's a basic rate taxpayer. They put in £1,138. There's a leakage of 40.24%, leaving them £680 left. So once you take into account the employer NRC charge, you've actually got 40% of it going to HMRC. Couple of questions. Please let me know who needs tax licenses with the exception of those in the CIS scheme. So I think that was on the previous slide. What are we looking at before tax conditionality? That is licenses to drive taxis and private hire vehicles, to operate a private hire vehicle business, or deal in scrap metal. Those are the people. And in terms of a copy of the slides, I think it's been on the chat box. They are available for you to download under PDF. Okay. Okay. And why is employment taxes so important? Well, because small changes, large consequences. elements that you would think about there. Let's have a look at the chat. Yeah. So if you've got a temporary workplace, you're seconded temporarily somewhere, then you may get travel and subsistence costs as being deductible, whereas with a permanent workplace, there is no deduction given. In terms of secondment versus new employment, if you're seconded somewhere, again, you may get detached duty relief, which allows you to deduct the temporary travel and subsistence case expenses, but you couldn't do that for new employment. If you're more than 183 days in a particular location, you'll get full national insurance tax and tax charge if you come to the UK and spend 183 days in the UK in a tax year, whereas less than 183 days, there are potential reliefs, including double tax relief. In terms of temporary elements, you might look at if you spend greater than 24 months in a temporary place, then there are no deductions generally available. Whereas if you spend less than 24 months on secondment, away from your normal place of employment, you might get, if there's less than 24 months, you might get detached duty relief. Big differences again between non-UK domiciled individuals, where potentially for 15 years they can get tax advantages, as opposed to UK domiciled individuals. Tax approved or advantage share schemes. Again, what you're looking at there is the potential for considerable tax advantages if you operate a company share option plan or a share save plan or a share incentive plan. Those are well beyond the scope of this course, but a big difference between that and also an EMI plan, enterprise management incentive plan, where you can get relief and potentially only pay capital gains tax, maybe only at a rate of 10% on your gains in an EMI plan. Whereas with a non-approved plan or non-tax advantage plan, a normal plan, you would end up paying income tax and potentially national insurance. And the total cost, including the employer cost, could come to 60%. So 10% EMI versus potentially 60% when you look at non-tax advantaged plans. And then the non-remittance of funds, particularly if you're charged on a remittance basis, non-UK domiciles, that would give you an advantage over remittances to the UK. So small changes, large differences in tax liability. And I'll just give you one example here. Somebody on detached duty for nearly 2 years, if they get the detached duty relief, then potentially all the housing, travel, subsistence and utilities, no tax, no employee NIC and no employer NIC. Whereas if I have to gross it up, if the company pays the tax on your housing, travel, subsistence and utilities, you could end up with an employee bill grossed up, so where the employer pays the tax on behalf of the employee of around £124,000, an employer NI of another £36,453 on top. So you can see the difference there between a cost that would be somewhere close to £160,000 and a cost of additional cost of zero. That might be quite extreme. You may have to apportion some of particularly the housing costs, but it's not impossible. And that could be the difference between a well-structured temporary detached duty and a badly structured change of employment. And then I'm going to move on to pay, benefits, expenses and bonuses. So claiming deductions, as we talked about, in terms of employment, you have 4 elements of expenses. They need to be wholly, necessarily, exclusively in the performance of the duties, or wholly, exclusively, necessarily in the performance of the duties. And therefore, a much tougher test to pass them. And we'll talk about that a bit later on. Generally speaking, it is much more difficult for an employee to secure deductions for expenses that he or she have personally claimed, because if the company or employer has not sought to pay those expenses, the obvious question is going to be as follows. If the company didn't think they were necessary, why should we think that they were necessary? If the company has not provided those facilities or paid for those expenses, why do you think that they should be deductible? And it's often the necessarily and in the performance of duties that becomes the issue. Let's look a little bit at the compliance. So 6th of April, start of the tax year, 19th of April, deadline for payment of tax for the prior tax year. That's the final payment before you get interest. Although, of course, you could, there is a requirement, generally speaking, to pay on a quarterly or monthly basis. There may well be a reconciliation at the end of the year. 19th of May, P35 submission. 31st of May, P60 goes to the employee. That is their statement of pay and tax deducted. Further in the calendar of events, what we're looking at is a payment of the second payment on account by an employee. Sorry, whoops. Where have I gone? I've gone past that, haven't I? Sorry. 6th of July. Apologies. 6th of July. So a lot needs to be done by effectively 92 days after the start of the tax year. You've got the share declarations that are required. Used to be on the form Form 42. They're now electronic share declarations. Form 39 and 36 in terms of tax advantaged plans. P11DB, so you need to do the statements of benefits. So if I provide my employee with a car or medical insurance, that needs to be done by the 6th of July. And if I've done termination payments plus benefits, which take the amount over 30,000, I need to put those on a return. If I think about the risk element, if I get the share declarations wrong, then my employees will probably get that wrong on their tax returns. And therefore, on that basis, they will be subject to inquiries. And the company may end up having to deal with those inquiries because they emanate from wrong information given by the company. In terms of P11D, that is the statement of benefits and expenses. And again, the penalty for getting that wrong could be as high as £3,000 per P11D. But what normally happens is where there's a mistake, the company pays for the benefit on a grossed up basis. Ouch. That can be extremely expensive, where they don't just pay the tax on the benefit, because they're paying it rather than the employer is seen as an additional income, and therefore there is tax on tax, possibly doubling your liability. The P11D is obviously an area that can also go horribly wrong. For example, if you don't have a mechanism for ensuring that the employee is only recompensed for business mileage rather than private mileage, then you get the fuel scale charge, which is going up next year to £27,000. So again, essentially, incredibly important to get your fuel mileage records correct, because otherwise in a pay-as-you-earn audit, you could end up with a very, very large benefit in kind charge on that basis. Let's have a go further in the calendar of events. 31st of July, payment of the second payment on account by employees for their tax. So, for example, for the year ended 5th of April 2022, I paid my first payment on account in January of 2022, so during the tax year. The second payment on account would be July 31st, 2022. And then once I've filed my tax return, the balancing payment is due on the 31st of January 2023. So any balancing amount. Remembering that the payments on an account are normally based on the prior year's tax liability, and any increase in tax liability would then be accounted for by the final balancing payment on the 31st of January 2023. The 31st of August sees the calculation of the pay-as-you-earn settlement agreement, 19th of October, the payment of the pay-as-you-earn settlement agreement, and the 31st of January, the submission of the self-assessment returns and the payments of any balancing tax. In terms of monthly events that you're looking at, so real-time information submissions where you've got pay-as-you-earn, they'd include things like full payment submission. That's required for every employee, and you need the full name, their gender, date of birth, full address, and national insurance number. That is needed for every RTI submission. Now, is that a big issue? Well, it's like most processes, starting it off, getting all the right information in the right place can be quite labor intensive. But once you've got everything in place, it becomes less difficult to do, particularly if you have reasonable software. In terms of the types of compensation that you've got, so pay is reported on a payroll, and national insurance would be due, generally class 1, employer and employee C, employee NIC, and is generally done on a monthly basis. For P11Ds, that is your benefits, that would be on the P11D, and generally speaking, you account for the tax annually on your self-assessment tax return unless it's included in your tax code. So, for example, your tax code may be adjusted for benefits that don't go through the payroll system. Expenses, P11D, we're not covered by dispensation, and generally, again, annually by self-assessment. Unapproved shares, you're going to put on digital forms, so non-tax advantage shares, and the tax would be reported if they are readily convertible assets, i.e. quoted companies or companies where there are selling and paying arrangements available. That would be on the payroll, and the payroll would be the tax would be paid a month after the taxable event. And class 1 employer-employee NIC, unless you've made an election to disapply and pay the tax up front. And the bonuses would be entered on the payroll just like everything else. You always have to look with bonuses to what period do they relate. So if an individual has a period of non-UK residence, part of that bonus may relate to a period of non-UK residence and therefore may not be taxable in the UK, but taxable in another country. Give an example, let's say I had a bonus, it related to 3 years of employment, but in 2 of those years I was employed in, say, Singapore and Germany. The UK would look to tax the element relating to UK duties, i.e. the UK year of UK residence, and the Germans and Singaporeans should tax 1/3 each of the bonus, which relates to the period that I was in Singapore and Germany. The other element with national insurance is you do have to watch if I have a certificate of coverage, meaning that I have a continuing liability to NIC in another country under a social security agreement. That could mean I end up as category X. And if I put that code in, then no UK national insurance would be due. So who pays? If it's a P11D, who pays the income tax? The employee. Who pays the national insurance? Employer only. Is there a gross up? No, because the employee is paying his or her own tax. For the payroll, it's employee, the NIC, and that's one of the big differences, in payroll is that it is both primary and secondary national insurance, so both employer and employee, and no gross up. If you have a pay-as-you-earn settlement agreement, that is normally on things where benefits are difficult to apportion between individuals and the company wants to pay the tax. That is an employer-only income tax charge. It's an employer-only national insurance charge, but it's bigger because the employer is paying the employee's liability. That adds to the taxable income of the employee, and therefore you gross up and effectively quite often almost double the tax bill. Let's give an example here. If an employee obtains £1,000 of benefit as an additional rate taxpayer once the national insurance rises are reversed, what we've got here is on the P11D income tax charge of £450, national insurance charge 138, but employer only. Payroll would be 450, 130, so those are the same, but there'd be an NI cost of 2%, which is of course £20. For a pay-as-you-earn settlement agreement, the employer would effectively, we're looking at nearly, more than doubling the cost when you take into account national insurance. Effectively, it's £818 of income tax, £250 of national insurance on that basis to the employer, and no costs, either tax or national insurance, to the employee. Where you've got basic rate, what you can see there is that the figures change. You've got a marked differential in terms of if the payments go through the payroll, then it's not a £20 charge based on the current rate of national insurance. We're talking about £120 differential for a payroll item rather than a P11D item. And what you can notice there is that the gross up element for the pay-as-you-earn settlement agreement is considerably less because of the reduced rate of tax. And the employer NIC again would be less because you're effectively, you pay employer NIC on the tax paid as well, so that reduces that figure. So where do you report benefits? So you've got to look at how the benefits are provided. So direct between the employer and employee would be a P11D item. Major benefit, you're going to look at cars, medical insurance, cheap loans. Payroll, the employee lays out the cash and is reimbursed, and that would have to go through the payroll. So if I pay for something and my company agrees to reimburse me, the reimbursement itself goes through the payroll. Typical benefits, you look at a home telephone in employee's name, commuting costs and other extras. And where the employer provides the benefit for a pay-as-you-earn settlement agreement, typical benefit would be staff entertaining and some rewards that quite often, you don't want everyone going around the table and saying, well, I didn't have a main course, or I had a cheaper starter, so therefore my tax bill should be less. Generally speaking, on staff entertaining, it either comes through one of the exemptions like the annual function exemption, or the trivial benefits exemption, or the company will pay the tax. Quick reminder, obviously wholly necessary and exclusively in the performance of the duties. What I would do is I would say that contrast that to a position where an employee is put in the position to do the duties. One of the elements that you would say is, for example, why won't you get commuting costs? Because you're traveling to the office. You wouldn't do that in any other circumstance other than for work, but that is putting you in the position to do the duties and therefore would not be allowed. Of course, there are some caveats. It's not a reductum ad absurdum. You don't take it to the nth degree. You don't say, oh, well, You're not going to get the costs of an office because you could work in a library instead. Some apportionment between private and sort of private expenses and business expenses is allowed, particularly on the use of a car. And the employer has a major input on what is allowable. So, for example, if the employer deems it necessary for you to travel first class, a lot of companies have a policy that you can travel business or first class after if the flight is more than 5 hours. That's the employer's position about how their employees should arrive at the place ready to do business, and therefore you're allowed a deduction for both first and second class travel. Expenses and benefits, as I say, you're often looking at elements such as business entertaining, business travel. Business entertaining, not taxable on the employees generally, but would not be a deduction for corporation tax purposes on the company. Business travel, normally fully allowed, as long as it's not commuting costs. Fees and subscriptions to professional bodies. HMRC has a list 3 that you can use. Deduction, hire cars, hired for business, business use of telephone, business expenses on business credit cards, business fuel, and other elements which would be allowed, generally speaking. In terms of expenses, there used to be something called a dispensation. I can't believe it's been gone for now 6 years. So there was normally a requirement that you don't have to put it on a P11D if it falls within certain categories that were pre-agreed between the employer and HMRC. The expenses element has disappeared, the dispensation has disappeared. And what you're now looking at is HMRC is satisfied that expenses are properly scrutinized, controlled, administered efficiently, and may be subject to inspection by HMRC to demonstrate that. Leave just 1 minute. Any questions? If there are no questions, let's go to polling number 2. So if you could answer those, give you a minute to think about it. Okay. So what are the results? Yeah, I think that there's going to be an element on, quite a large element on COVID-related payments. Employment taxes and corporate taxes, yes. I would say that is normally a rich seam of for investigations and HMRC collecting money. And I agree that capital taxes would be quite a lot less. So yes, I would say they're going to be looking at recovering COVID payments. There's quite a lot of pressure for that. And then obviously as COVID hopefully moves into the middle distance, then we can but hope on that basis, then they'll swing their attention to other elements. But yes, the government is spending quite a lot of extra money on compliance activities. Thank you. So looking at COVID payments, furlough mistakes. One of them is non-existent employees, which is straightforward fraud. Working employees, non-payment to employees, non-inclusion. So at the beginning, so obvious non-existent employees, you've just made up employees and you've claimed furlough, straightforward fraud. Working employees, at the beginning, in the first elements of furlough, employees could not work at all. there may be some residual duties for directors. And then partway through the process, if the rules were relaxed for new claims, that you could work part of the time. Where furlough has been claimed but not passed on to employees, not included in real-time information, and non-inclusion in CTCom. So, for example, the self-employed income support scheme is a taxable payment and therefore should be included in the corporation tax comms. Where you have received furlough payments, clearly that has reduced your deductible employment costs. So we will see, I suspect, a very substantial increase in the amount of people being caught by this. And indeed the timings of this in terms of when you needed to have a payment made in order to qualify for the first furlough payments might be quite interesting. So let's say you employed somebody in February, but their first payroll, February 2020, but their first payroll was actually on the 25th of March. That would have been beyond the date of the cutoff for the furloughing payments. So again, looking at the timing of the cutoffs, quite often the cutoffs were when was the person actually given the first payment. If they weren't given the first payment by the time of the furlough cutoff, you can't claim furloughing. So important to look at the timing of the payments, who they went to, whether they were all paid out to the employees, what you did about the RTI, and what you've done about including those payments, both furloughing and the self-employed income support scheme payments, in your corporation tax comms, either as a form of income, but also that will reduce your deductible expenditure. And on that basis, let's look at HMRC's powers and the environment that they are in. So HMRC has powers to assess companies, directors, and employees. They can do Section 9A legislation. So back, it's in the Taxes Management Act 1970. And what they do is they consolidate pieces of legislation back in what they call the compliance legislation, which was put in 52 years ago. So, but that has been changed. But once you have a change and it's passed in the Finance Act, it is then consolidated back into the relevant piece of legislation. And then a reminder, HMRC has a power to inquire under 9A, not a power to ask for information and documents. But if the tax return is delivered on time, 12 months from the day delivered. If the tax return is delivered later or amended, quarter day following the anniversary of delivery amendment, or the date of receipt is relevant. And then in the question, does HMRC have the right to ask? The scope of the inquiry in terms of documents and other elements, they can ask about anything contained in the return or required to be contained in the return, including any claim or election included in the return. And then with amended returns, what we're looking at is when can no longer inquire into the whole return, scope limited to matters to which the amendment relates or which are affected by the return. So it's not like they can have a whole what is called fishing expedition and just cast their nets and try and get everything. It has to be related to the inquiry that they have. And then information requests, which are different from the inquiry, is the power to ask for information and documents. What we've got is a notice in writing requiring a person to provide information or to produce a document that is reasonably required for the purposes of checking the taxpayer's position. Now, on that basis, What is the risk to the advisor? The risk to the advisor is that they give information that HMRC is not legally entitled to give, and then they'll get a problem from their client that they've given away information that HMRC was not entitled to have, thus potentially prolonging the investigation and creating more potential cost for the client. So again, really important to look at that and make sure that the terms of any investigation or request for information is done properly. So you've got to look on a legal basis. What information can be requested? What is reasonable? What is a document in a person's possessional power? So, for example, the HMRC has no power, for example, for me to produce documents that are my wife's, for example. They can ask my wife for the documents, but they can't ask me to provide my wife's documents. And if, as an agent, I am only empowered to act for the husband, not the wife, I can't make disclosures on behalf of the spouse on that basis, and to do so would be negligent. What must you do if you receive a Schedule 36 notice? Well, you need to think about what is the scope, what is being required, does it look reasonable to the investigation being carried out? And there are, if you like, two risks there. The one risk is that you give far too much information that has not been requested and prolong the inquiry. Even if the taxpayer has nothing to hide, just giving loads of information will tend to generate more questions. And even if those questions don't lead to more tax, they do lead to more costs. That would be one element. The other element is that you don't cooperate with HMRC's reasonable requests, in which case there could be a fine both on you as agent as well as your client. The other restrictions are you cannot request documents from a tax advisor on advice about a person's tax affairs unless the advisor helped in the preparation of the return and documents and explains how, and the document explains how an entry was arrived at. In other words, it needs to be relevant to the return. Can request information from an individual, but rarely is that relevant to checking a tax position. In terms of common themes on this, and this gives you an idea of the sort of risks involved, we're looking at a potentially compliance check or informal inquiry. That HMRC may try and carry out an informal inquiry. What are the risks of that? Well, the risks of that are very clear, that you're giving away information that the client may not wish you to give and which you're not compelled to do under an informal inquiry. However, cooperating with an informal inquiry could stop a more difficult formal inquiry with Schedule 36 notices flying around later on. It could be carried out over the phone, discussing apparently obvious errors or missing information. They may want to understand the business or share perceived risks. And sometimes a telephone inquiry is a very cheap way of nipping a potentially much more expensive inquiry in the bud if you, you don't really want it extending further than it does. Should you challenge that element, obviously you've got to look at client confidentiality. HMRC can only formally inquire once. If informal, an inspector can open one later and further fees would be necessary. Let's have a look at the Q&A. Schedule 36, fines for agents, please elaborate. So what we're looking at, Richard, is if, for example, I have seen fines for agents where they have been obstructing an inquiry, delaying, not replying to reasonable requests on that basis. So what we're looking at is I can remember a particular case where an agent failed to respond on that basis and therefore used delaying taxes. It's years ago, and a fine was imposed on the agent. There is a difference. A third-party notice is normally a notice on a bank or a financial institution. So, for example, let's say I bank with XYZ Bank. HMRC can ask for details from XYZ Bank about my tax affairs. That's a third-party notice. This is talking about conduct of agents in an inquiry, and if they are obstructive, there can be fines for agents on that basis. Hope that answers your question. So in terms of an informal inquiry, the risk is that if you don't take it seriously, they'll open up a formal one, which is generally more costly, and HMRC has the expectation that they're not going to give up until they've got their money or something, whereas an informal inquiry offers them the opportunity to be satisfied and decide we'll move on and do something else. Let's have a look further. Discovery powers. What are we looking at there? In terms of discovery powers, what we're looking at is the ability to reopen a closed year. HMRC has discovered something is not correct. Assessing power, not information power. They are different. Time limits, error or mistake, 4 years from the end of the relevant tax year. Careless, 6 years from the so if either the agent or the taxpayer has been careless, that period goes up to 6 years, which is the same period as you get for the requirements of stored documents. 12 years if it's a non-UK matter, and deliberate would be 20 years from the end of the relevant tax year. So once you get to 21 years, you're in the clear, they can't do anything. But looking at the step up from 4 to 6 to 12 to 20, it's generally more serious elements, gives HMRC longer to open an inquiry. And as I say, for non-UK elements, they've now got 12 years. Common themes on straightforward matters. So where I've got straightforward matters, what am I looking at there? Well, missing bank accounts, missing employment income, checking all income has been reported, and reinvestment of disposal proceeds in a capital gains tax element. Focus on making sure we get the easy bits right, and making tax digital may assist or it may not. In terms of the more complex matters, we're looking at UK residency. So what is the start end date under the statutory residence test? What is the position on dual residence? Overseas work days, remittances to the UK, awards, confirmation, termination payments, the away from home allowance, detached duty relief, foreign tax credit claims, and incidental versus substantive work days. Those are good examples of more complex matters which may come up and will require more specialist work. And then, of course, HMRC moves on to the penalty regime. And unlike some, HMRC normally scores on that basis quite heavily. And what are they looking at? Well, errors on a tax return, HMRC needs to understand the nature of an error on the tax return, and the sort of questions that they ask will inform the level of penalty that they'll seek. And penalties have generally been going up, and answer questions about why did it happen, could it have been avoided, what actions did the taxpayer take to check the return, was it a one-off mistake, or was it a systemic mistake? So something where, you know, people make errors, and even HMRC will understand that people make errors, but was there something that was systematically wrong where there were no checks done, in which case that's a more serious element. And the answers there will generally determine the next stage of any inquiry process. In terms of the elements, what we're looking at is a real ramping up of the penalties. So what we're looking at is mistake, you get no penalty if it's what we call, what used to be called an innocent error. Carelessness, if it's an unprompted disclosure, in other words, you found out that something's wrong and you want to make it right, you could end up with no penalty, but if it could go up to 30%. A deliberate understatement, you're looking at up to 70%. And if it is deliberate understatement and concealed, it can go up to 100%. And that penalty can increase by 1.5 or 2 times if an offshore matter. And the element you need to think about there is there a mitigation approach? Because quite often advisors, you know, the tax has been agreed, and what you see increasingly is disputes going to the courts on penalties. And can you get the penalty suspended in return for good behavior by the taxpayer? And then in terms of penalties, what we're looking at is a failure to comply with notices. It could be an initial £300 and thereafter £60 per day. And then in terms of providing inaccurate information when complying, if it's careless or deliberate, the maximum penalty is £3,000. Okay, I'm going to look at conclusion and other matters, but let's have a 5-minute tea and comfort break. So conclusions on the investigations, I would say they hold both risks and opportunities for agents. So consult with others and share experiences, check notices have been validly issued, consider housekeeping, risk management and confidentialities, and think ahead and try to understand where HMRC are coming from, and, you know, keep yourself updated, not just yourself, but your colleagues if you're working in-house, and if you're working as an agent, clients as well updated. What you don't do, in my opinion, you don't be afraid to challenge HMRC requests and views. You know, they are not infallible. They sometimes ask for too much information. So do look at that, but don't provide information not relevant to the tax return. Don't lose sight of the potential penalty position. So don't be over obstructive where HMRC have reasonable requests. In the next part, I really want to look at something which is a question which comes up regularly, is how will they get to know what you are doing? And HMRC does have increasing powers and capability. So I was just thinking about the ways of getting information. So things you might look at would be like the landlord deposit scheme. So it was reported in the papers quite recently that HMRC has used the new landlord deposit scheme to work out how much how much rent landlords are getting from tenants. The landlord deposit scheme, which is put on a statutory basis, gives a good idea of the level of rents coming in. Internet advertising, obviously, COVID figures, credit cards and debit cards are great ways of getting information without actually having to pile in and issue notices to you. I pointed out before that the extension to the time limits to assess non-deliberate offshore tax non-compliance increased to 12 years, and that replaced the current limits of 4 years and 6 years, 4 years for reasonable care and 6 years for carelessness for offshore matters. It's still the same for domestic matters, but because of the amount of information, something I'll talk about in a little bit, that HMRC is getting from offshore, they are widening their offshore attacks. So the question always comes, if an inspector calls, why are they picking on you? Well, as I pointed out, there are plenty of pieces of information they can get from social media, such as Twitter and LinkedIn, or Facebook or Meta. Third parties like building societies and banks, state agents, foreign tax authorities, and of course, from disgruntled employees, particularly when it comes to COVID payments. A lot of employees have used the COVID helpline to report employers who they think have diverted or misused COVID funds. Other sources, of course, are neighbours, divorces, local newspapers, and of course, all the elements of the government which can now talk to each other on these different elements. So, putting yourself in harm's way, your tax returns are inconsistent with how busy your business actually is or your standard of living. So this comes up quite often when HMRC says, you've got a very high standard of living, how are you affording this? Is there a gap in the finances that we're not being told about? You've got offshore bank accounts, so you're perfectly entitled ever since 1979, when exchange controls were lifted, to have an offshore bank account. But are you declaring the interest from it? And probably more relevant to it, where did the money come from, the capital come from in the first place? If you have income from property, or you operate in a high-risk business, such as businesses that routinely take cash payments, or a business industry that HMRC has decided to target, a bit like construction industry, or HMRC receives a tip-off, and as I've indicated, they get lots of tip-offs every year. And the tools in the box, the senior staff they're recruiting, the Connect computer system, more about that a bit later, the automatic exchange of information provisions, and new criminal and civil penalties. So, when we're looking at in the toolbox in terms of international elements, we're looking at things such as the automatic exchange of information between different jurisdictions, common reporting standards that comes up regularly, where a third party, let's say you have a bank account in a foreign country, and that bank will then report on a common reporting standard to their tax jurisdictions. So you have an account in France, the French bank will report it to the French tax authorities, and the French tax authorities will then send that information to HMRC. Country by country reporting on companies, that's only generally for very large companies with a turnover of above 750 million euros. But that extends to groups of companies. So maybe you're only responsible for a fairly small company, but it is part of a larger group, and therefore there are enhanced reporting requirements and also treaty rights as well. The rights under the treaty for HMRC both to expect and give cooperation both on the provision of information and indeed the collection of tax debts. So I had somebody where the German tax authorities were pursuing what was not a huge amount of money, and the client, I think, thought that they were safe being in the UK, but actually HMRC ended up trying to collect the tax debt on behalf of the German tax authorities. As I say, a reminder of the HMRC powers: request reasonable information, and I do say reasonable information, demand documents from both the taxpayer and third parties by serving relevant information notices, and make assessments as estimated in the absence of relevant information from the taxpayer. In terms of what I call the heavy mob, if things get really bad, they can raid commercial and domestic premises to seize documents, put a lien on goods, which means that you can't be sold except for to pay the tax debt, collect sums from bank accounts without resort to the courts under the direct recovery of debt system, withdraw licenses like the CIS gross payment, the construction industry gross payment status, levy penalties and interest, and initiate criminal proceedings. And then in terms of offshore, a reminder that and this is from HMRC's own No Safe Havens document, published in 2019, they now have the global exchange of financial information, which was not available in 2010, comprehensive penalties for UK tax evaders and enablers of tax evasion. So even if you enable tax evasion rather than do it yourself, so you say this is the way to do it, but or provide facilities to do it, so that's a positive, or rather an action that could get you fines and penalties. And for corporates, so companies, they're criminally liable for failing to prevent the facilitation of tax evasion. Where are their processes to stop employees evading tax in the course of company business? Not on their personal tax affairs, but in the course of company business. And also internationally agreed rules to tackle multinational profit shifting, where companies shift profits into tax havens or lower tax jurisdictions. That's a major issue that you need to think about. In terms of the tax information exchange partners, everywhere in green is still valid, except for the big blob, which is, the big bit on the top right-hand side, which is Russia, where unsurprisingly exchange of information protocols have been suspended. But if you look at that, that covers most of the world where you would want to put your money in investments. There are exchange of information protocols, and those protocols have bite. 2018, 5.67 million records were received on UK taxpayers' offshore financial accounts, and this has been built on. So the Focus Connect HMRC analytical tool, which you can look up, developed, is one of the most sophisticated revenue collection computers in the world. It cross-references more than 22 billion lines of data, including customer self-assessment returns, property and financial data. So even if you're dealing with solely UK taxpayers, if they've got property abroad, you need to be concerned that it is properly reported. And Connect identifies more than 500,000 cases, both onshore and offshore, for HMRC to inquire into every year. Oops. The other element, which is becoming something that has been accelerated, particularly in the wake of all the sanctions on Russian oligarchs following the invasion of Ukraine, is information exchanges and public registers of interest. And the UK is accelerating those to try and effectively make the sanctions regime more effective, but it will also potentially help with global tax enforcement. So what do they do? Well, once there is information and the computer systems have said, we think that you should be investigating blogs, then there would be some form of case conference, probably by inspectors of taxes, and they would get together to determine, is there a VAT issue connected to a corporation tax issue? What has happened with capital? And what has happened in the directors or individuals' personal self-assessment returns? So in an age of tight resources, even with the extra money going to HMRC, random is rarely random. It generally starts off a letter saying we have reason to believe that there is an issue. So they don't often say, they don't do a reverse Hunger Games where they sort of pick a UTR out of the hat and say, we're going to audit this person. We know nothing about them, but we feel that we need to do a number of random audits just to keep everyone in line. Or pour, as Voltaire would have said, pour encourager les autres. But here, what they do is they get the information, and that information gives them a wealth of targets of whom to pursue. And then something that was talked about before, there could also be third-party information notices under FA 2008, Schedule 36, Para 2. And there are data gathering notices under Finance Act 2011 to request bulk data from relevant data holders, such as banks, building societies, and so on. In terms of rents, what we're looking at is additional powers, because HMRC believes that rents often disappear without being properly recorded. So they can ask for information from a lessee, an occupier of land, or a person having the use of the land, and also a person as agent who manages the land or is in receipt of rent or other payments arising from the land. So they can go to managing agents and ask for information. The other elements that they look at regularly would be merchant acquirers, those processing debit and credit cards. So if you think about it, every time you go and spend money on your credit card, HMRC can get a report on it. And also business intermediaries, those booking and reservation companies, such as those taking payments for holiday accommodation. So travel agents, you make a large booking for a round the world cruise, for example, then HMRC may well get a report on that. And it's still restaurants supplying takeaway food and outlets reselling tickets for entertainment events. So the wealth of information is huge, and even goes as far as those electronic payment services. So digital wallets, the sort of things where people pay with their Apple phone and smartphones. Those are the sort of elements that again HMRC can get data on and uses its enhanced computer systems to link it up to the data it receives from taxpayers. And of course you've got government departments, so they're not working in silos. You've got, for example, the Companies House, where you've got the where all company information is stored. The Driver and Vehicle Licensing Agency, buy a flash car, HMRC will find out. The Land Registry, buy a second or third property and fail to declare either the rents or the sale of the property, and HMRC are very good at finding out about sales of property, and oops, it's your second property, where's the capital gains tax? Didn't you make a gain on that? Did you do the return within 60 days? You could be looking at the Capital Taxes Office, and of course the Department of Work and Pensions as well, in terms of benefits and other elements that people are receiving. And the question then is, how does HMRC know? So good point about that. This is our ward versus HMRC. Taxpayer claimed to be non-resident for 2009-10 and 2010-11. And joy of joys, HMRC got information from the UK Border Agency for the 2 years. Remember that every time you go through passport control, there is a click on a computer. Whether you go through it electronically, and stare there at the screen until they open the doors for you, or if you go and see a person and they say, welcome back to the UK, hope your holiday was nice or something. Each time they put it on the computer, that information goes to the border agency, and then HMRC can get hold of it, which it will do for a resident's case. And in this case, proved that he spent over 183 days each year in the UK and therefore was resident in the UK. And in terms of third-party information, of course, they're looking at the relationship between the taxpayer and their suppliers and customers. And the cogs in the wheel, the gap is the margin that is being paid between the customers and the suppliers on that basis. Where is the margin that you make? If I look at another fantastic case about the information, this was about something called foreign service relief. You don't probably need to be too concerned. Special regime for termination payments. The taxpayer claimed to be not ordinary resident. I'm not particularly interested in the case per se at this point, but it failed on the fact how easy was it to get a picture of the taxpayer's lifestyle. Now, I love this case because HMRC went to quite a lot of trouble to find out, and presented the facts to the first tier tax tribunal, stated the evidence was not consistent with Mr. De Silva's claim that he spent 70% of his time outside the UK. He had an annual rail season ticket for travel, regular payments on his credit card and out of his bank account to UK golf clubs, other members clubs, bars and restaurants, a London gym, and even more concerning from that point of view, how could they know where he was? Well, frequent cash withdrawals from London cash card machines. So he'd left an electronic footprint everywhere. Another case that I think is fantastic on this basis for showing what can be done is, and I use that as cautionary tales with my clients about, don't think HMRC can't find out. So in this case, claims by the PECs that they were not resident in the UK. And in this case, HMRC were able to plot PEC's lifestyle, the couple, from their credit cards. They needed, under the old rules, to show that they had a distinct break in UK interest. And thus, the fact they'd spent less than 90 days in the UK in the years in question was insufficient to show they'd created a distinct break, and it showed the efforts that HMRC will go to. And the credit cards were used to show when they were in Sussex, where they went, who they met, what they did, which restaurants they went to, which shops, and they plotted their lifestyle and said, well, your lifestyle is exactly the same for the period before you claim to become non-resident and afterwards, and therefore we don't think that it shows sufficiently that you've changed your residence position. Now, that is probably less relevant than the wealth of information that HMRC was able to get. I'm now going to have the third poll, if I may. Okay, let's see the results. Oh, VAT. Well, that's really good because I'm going to come to a bit of VAT. I'd be interested in, or I can't ask you, but the interesting element is VAT because it's so complicated and people find it so difficult, rather than inherently that they should be, VAT should be more of an issue than others. But the only other thing I always think about with VAT is you don't need to make profits to have problems with VAT. You just need to have reasonably high turnover. But useful to know that actually, sort of an absolute majority of people are looking at VAT. So I do come to that fairly shortly. Thank you very much. So let's look at tax and insolvency. So VAT is one of the elements where HMRC moves up the creditor hierarchy for taxes paid by others. So remember, I talked about the fact that it's withholding tax. HMRC, if you are withholding taxes on behalf of HMRC, VAT you charge should be paid on, pay as you earn the same. Employee but not employer national insurance, student loan deductions where it needs to be paid on, or construction industry scheme deductions. All those elements have all those taxes are elements where you're withholding it on behalf of HMRC and should be paying it on. And if you don't do so, then HMRC moves up the creditor hierarchy to be able to claim it before most other creditors. And then the element you need to think about there is the joint and several liability of company directors. That allows HMRC to recover tax and other liabilities generated through tax avoidance or evasion. The other element that they look at, and that becomes a particular risk, is if you've been insolvent before or you've collapsed a company before, then very much the case that HMRC will go for you on that basis. So, you know, the first time they might say is bad luck. By the third time, they're looking at deliberate and potentially reckless behavior on that basis. Other elements that I've talked about and where they've increased the penalties, that would be penalties targeted over for overseas elements. So section 162, penalties for enablers of offshore tax evasion, penalties in connection with offshore matters and offshore transfers, where you've transferred assets or income abroad, offshore tax errors, and we have the 21st century equivalent of the stocks, where you publish details of deliberate tax defaulters. And this one is an interesting one, asset-based penalties for defaulters for offshore inaccuracies. So let's say I had a pad in Ibiza worth several £million, and I failed to declare the rent. I don't just have a problem with the tax on the rent. HMRC could go for me based on a percentage of the capital value of the property in Ibiza as well. And then other offences relating to offshore income assets and activities. So very much targeted overseas. And as I said before, leveraging on licenses for businesses non-compliant. HMRC informs other parts of the public sector, and licenses may well be refused. Why is that different from the conditionality I had before? Well, let's say you're a company providing services or goods to the public sector. Now, in certain areas I talked about before, like scrap metal dealing, you need licenses. But one of the other elements might be that a public sector body will ask in their tender document for proof that you're compliant on taxes. So beyond what the statute says, they might want to know that you're compliant. And you will find you won't get the public sector contract if you are not compliant. So that's a huge risk, and it's becoming a bigger risk as HMRC becomes sort of a bit cuter at wielding the stick in terms of non-compliance. And then with repeat offences, first offence not deliberate, HMRC informs taxpayer of the error, and then the repeat is subject to deliberate penalty failures. Let's look a little bit at expenses, because that might be an interesting area in terms of penalties and pay-as-you-earn audits and in-depth checks of companies. Types of claims you can have, so you can claim protective clothing, uniforms, business travel. You could part claim home expenses when used as business premises, but the claims have gotten less generous since the 6th of April 2022. So they were more generous during the COVID pandemic. They've become less generous now. Car costs apportioned between private and business use. What you can't claim is normal clothes or personal expenditure. So even if you only wear a tie for work, that is putting you in the position to do the work, and you would not be able to claim for the ties. As an example, the famous case is Lady Malilio and her barrister's clothing, where she wasn't able to claim for the clothes that she wore. She said she wouldn't wear them outside court, but the court said, no, the clothes are there for decency and warmth, and there is a duality of purpose. And the same would be true in terms of personal expenditure. In terms of use of home in business, so the position has got more complicated where the employer now provides you with an office space or a facility to use it. It is more difficult to claim that it is necessarily incurred in the performance of the duties. But where there is no office space provided, or where your base is at home, on that basis by the company's direction rather than your choice, then you might look at claiming expenses based on floor space, looking at the costs, and you would look at repairs, interest, insurance, utilities. Utilities, obviously a big thing at the moment, given the cost of heating places, office furniture, lunch, whilst carrying on duties, broadband, and don't forget that, you know, you have a premises that is used or part of it for business. There is also the cleaning costs as well. In terms of keeping your risks down, do think about always, even if you're an unincorporated business, having separate business and personal credit cards. You know, the number of times I've seen people on a Saturday night, you go out for dinner with them or the pub or something, and you split the meal, you know, sort of, and then suddenly you see the business card come out. Now, I'm off duty. I'm not going to say anything, but just remember that HMRC can see the timing, if they so wish, of when the credit card transaction took place. Saturday night at the local restaurant does not sound often like business expenses. It could be, you could be part of a business conference that spans a weekend, but, you know, date stamps, or basically the dates that are provided on transactions are quite useful to HMRC. So when you're on personal business, use the personal card. When you're on business, use the business card. And separate bank accounts, again, extremely useful. It makes it much easier at the end of the year to download the information from your business account and form the basis of doing the accounts. And using you know, intelligent software that your bank or others may provide may make it easier to produce those accounts. It also gives a good starting point when you're producing spreadsheets and then using those for bridging software for making tax digital. Again, separate accounts, I mean, this is obviously somewhat old-fashioned. You're going to be looking at computers, but you want separate accounts for your purchases and sales, ledgers. And of course, in terms of keeping receipts, it could be the old-fashioned shoebox for the physical receipts, although HMRC sort of encourages you to take scans of receipts, so you've got them there for the future, that, you know, particularly ones which fade over a period of time. It is much easier to keep them on, you know, telephones in terms of taking pictures or scanning those elements. And as I say, you know, one of those neat divider folders comes in very useful. Making tax digital. So I've talked about it a bit. Making tax digital has been around for a while now for VAT. And what they've done is they gradually bring more businesses into it. One, they've kept the threshold at the VAT threshold, and the VAT threshold hasn't changed for a number of years. At present, for the next year and a few months, effectively, it is connected to VAT. In other words, in order to do your VAT return, you've got to do it digitally. The portal which allowed you to just put the figures in no longer exists. You can't do it by paper. So at the moment, what happens is, let's say you do, so what I do, for example, is that I have a spreadsheet which is populated from my bank account that has all my expenses and my income. I have very few out of pockets. I do have some cash that I need to spend on taxis, although even that's become less over the years as more taxis accept credit cards. So most of my base information comes from my bank accounts. These are downloaded and then adjusted for a spreadsheet, and then I have bridging software which then puts it into a format that can then be bridged over into, hence the term, into the VAT portal to do my annual VAT return. What you're going to get is £10,000 threshold for traders and landlords, where they're going to have to do income tax if their income tax making tax digital process. What does making tax digital for income tax mean? Means you're going to have to do quarterly reports based on income and expenses on a quarterly basis, and then you do an end of year adjustment on that basis. For that, the likelihood is you'll need digital records, and probably on that basis, accounting software. And there are plenty of HMRC compatible accounting software packages that you could consider. It's not terribly long. It's April 2024 that is going to start. And so therefore, it's something that you will need to think about in the next while about, are your clients, are you ready for the expansion of making tax digital? There was an expansion in the scope at the beginning of this year. If you'd been voluntarily registered for VAT, i.e. your software, your turnover was below £85,000, you didn't have to register for VAT, but you chose to do so. You weren't within MTD. Now everyone registered for VAT is within making tax digital, and I say a huge expansion come April 2024 when it'll be used for income tax purposes as well. The returns themselves do not, the MTD returns themselves, apart from the VAT one, will not create a liability, but they will give HMRC more information in order to look at how the business is doing on a quarterly basis, and therefore look and see again in terms of risk analysis what is being done. Now let's look at VAT. So the question that comes up is whether to register or not to register, particularly if your turnover is below £85,000. VAT, as a reminder, is applied on goods and services. There are different rates of VAT. There's compulsory registration for turnover above of taxable turnover above £85,000. That is VATable turnover. It's a voluntary choice below this. And of course, it is linked, as I talked about, to making tax digital. Remember that the UK has all sorts of different rates. There are 4 rates currently for VAT. There used to be 5 rates when there was a special 12.5% hospitality rate, but that went at the beginning of this tax year. Think about things that are subject to VAT at different rates. So what we're looking at there is 0 rating for cold food, milk, coffee, tea, cakes, children's clothes, books, magazines, publications, newspapers, and some medical products. Why is that important? Because under zero rate, that is the most favorable element. You are charging customers, but at zero rate. And that means that you can reclaim all the VAT, or almost all the VAT, that the business incurs, which means that supermarkets and other most of supermarket, if you go down a till receipt, most of your supermarket shopping is likely to be zero rated. That means that the supermarket is likely to be reclaiming VAT every month. The same is true with exports. So those types of businesses, for them, VAT is something that they can reclaim as a source of cash back to them. Contrast that with exempt, where again, the end user is not charged VAT, but you cannot reclaim the VAT that you incur. And insurance and many financial services are good examples of that. Then there's 5% VAT, which is a special low rate on domestic energy, energy saving devices, helmets and protective wear, and some medical products. And there's a normal, you charge VAT, albeit at 5%, and you can reclaim your input VAT, the VAT that you have been charged. And then on catering and hot food, restaurants, and most other elements, you have the standard 20% rate of VAT. And on that element, the default basis is the standard rate of VAT. What is outside the scope of VAT is things like salaries, which do not affect calculations on that basis. Got a question? Please cover approach for sales via platforms like Google, eBay. I use tax report to analyze countries sold to. Is there an easier way? I'm not convinced there is an easier way to do it. So effectively, you need to think about, if you have a taxable presence in another country, the question would be is, if your turnover is beyond a certain level or in another country, you might have to register in that country, and some countries have very low levels. The other element is that the tax compliance, the UK has said, if you sell into the UK from abroad, we will potentially charge Google and eBay and Amazon if you don't apply the right amount of VAT. So the tax report, I'm not aware of an easier way of doing it. I'm talking about partial exemption at the moment, so hopefully, Greg, that will answer the point. The difference is, let's say I am an insurance business and I incur £10,000 of VAT. I won't charge my customers VAT, but it means that within my costs are the £10,000 of VAT. And of course, that could be a lot bigger if I have some, big offices and big VAT costs. What that means is that within the price that I charge for my service, effectively, there is a VAT element. So I have irrecoverable costs of £10,000. VAT I can't set against amounts I'm charging my customers, because I'm not even charging them at 0%. So in terms of the insurance that you pay, you do pay insurance premium tax, but within the main cost would be the cost of the VAT that I am unable to recover, and that would be exempt. Partially exempt would be, maybe I've got a mixture of things. Maybe I've got some products like insurance on which there is no VAT charge, and some products like certain advisory services on which VAT is charged, maybe at 20%. I then have to allocate my input costs between my taxable supplies and my non-taxable supplies. The taxable supplies, I can reclaim VAT on. So if I've got an advisory service and I spend £5,000 of VAT on the advisory service, I can reclaim that because I'm charging customers VAT. If I have some insurance products and I spend £5,000 on VAT in creating those insurance products, I can't reclaim that. That has to be in my main price that I charge customers. What if I have central overheads? Then I have to allocate them between the taxable supplies and the non-taxable supplies, and that could be done based on turnover, costs, sort of all sorts of ways of doing it. In the entertainment business, that could be done, for example, on floor space used between those different types of activities. Let's look at the VAT element a little further. So here, what I'm looking at is the point would be is that if you didn't have a sort of an ability to reclaim input costs and set them against output costs, that would advantage big business over small business. Why would it do so? Well, because a vertically integrated business would then just pay VAT once and charge VAT once. And if you didn't have this reclaim business, small businesses would pay a lot of VAT would be paid and not reclaimed all the way down the line. So the idea of the input, which is a cost, versus the output, you pay the excess of the output over the input to HMRC. And obviously, if you're a profitable business, you're going to have VAT to pay. You would hope a profitable business that is not zero rated or exporting, and in the normal course of business, let's say in lecturing, my VAT costs are relatively small, which means that because I'm charging 20% VAT for my lecturing, there is a large amount of VAT that goes off on a quarterly basis, or I consider a large amount of VAT that goes off on a quarterly basis because my VAT costs are very small compared to the VAT I have to charge. But let's take a process here. Manufacturer, you pay for the raw materials and services, that is input VAT. The charges for manufactured goods is output VAT. And what you'll notice is the raw materials I buy. So somebody else has charged VAT, but I take it from that basis. That then becomes my input VAT. The raw material provider has charged me VAT. That is their output VAT. When I've manufactured the goods and I sell them to the wholesaler, effectively, I charge for the manufactured goods. That is output VAT. And that becomes the input VAT of the wholesaler. So the wholesaler would have that as an element that they can then set against the output VAT, where they charge for the goods plus output VAT. So effectively, what was the output VAT for the manufacturer becomes the input VAT for the wholesaler. The wholesaler then sells that product, and again the output VAT for the wholesaler becomes the input VAT for the retailer. So the retailer would be able to use the VAT that it pays, including to the wholesaler, and deduct that from the VAT that it recovers from the customers, and the net amount is paid to HMRC, and the customer will pay output tax on the goods. And normally speaking, if the customer is not registered for VAT, they will pay the whole 20% without getting any money back. The VAT cost, obviously for a VAT registered business, the cost is the difference between the input and the output VAT. But obviously, if you're getting the output VAT from the customers, it is not a real cost to you if you're a VAT registered business making taxable supplies. If you are non-VAT registered business, then the cost is the total VAT charge. And of course, if you're a partially exempt business or an exempt business, some of that VAT that you paid for, you cannot reclaim against any VAT charges. You're going to have to charge the customers more money to make up for your total costs. When would you think about voluntary registration? Well, if most goods supplied are zero rated, then it might be something you would consider doing, because obviously you can reclaim the VAT. So you can reclaim the VAT, and therefore on that basis, there's no additional cost to the people you are supplying. So if I had a children's bookstore or a children's clothing store or food store, for sure I would want to register for VAT so I can reclaim that VAT. Or maybe you're supplying to customers who can reclaim the VAT. So most of the people I bill are registered VAT businesses, and they can reclaim that VAT. So, it would make sense. Even if I wasn't compulsorily registered for VAT, it would make sense for me to voluntarily register. And of course, exports, generally speaking, are zero rated, even now to the European Union, given that we've left the VAT arrangement. So therefore, zero rated supplies include exports. And therefore, the bigger exports actually do monthly VAT returns, so they get a regular cash inflow. Where it's not competitive is where customers cannot reclaim the VAT, or customers have restrictions on reclaiming VAT. So particularly when you're selling to insurance companies and banks, remember that the VAT is a real cost to them. Other VAT schemes, so you can do cash accounting. It's applicable if your turnover is less than 1.35 million. Annual accounting, where you only have to do one VAT return and you do 3 payments on account based on the previous year's VAT. So I do my year to 31st of March. So I've got 2 months to submit the annual VAT return. So I did it, I think, this year on the 11th of May or 12th of May. And then HMRC will tell me what, based on that liability, the final liability for 21-22, what are the quarterly payments I should make this year. I make 3 quarterly payments in July, October and January, and then do the annual VAT return shortly after my accounting period has ended in March 2023. And then, of course, you can get, if your turnover is below £150,000, you can use the flat rate scheme. What is the flat rate scheme? Well, you pay a fixed rate of VAT over to HMRC based on your turnover. You keep the difference between what you charge your customers and pay over to HMRC. And you can't reclaim VAT on your purchases because you're just doing it on turnover. So you keep a percentage of the VAT you charge in lieu, instead of having to detail every VAT element on your purchases. The only exception would be capital assets over £2,000. To join the scheme, your VAT turnover must be less than £150,000, and you have to apply to HMRC. In terms of recharges of VAT, what we're looking at is you would recharge VAT on expenses, even if those expenses are zero rated. So let's say I get on a train to see a client, the fee I would charge them would be the lecturing fee plus the rail fee, and VAT is charged on the lot. So that would include expenses of travel, subsistence and indirect costs. There would be no requirement to recharge the VAT where there are disbursements directly arranged for the client. For example, legal expenses. If I've arranged a solicitor to provide those services, there's no requirement for the recharge of VAT. My final points, I've got 2 minutes or so. So very briefly, recent developments on risk. One of the elements that's come up is that a lot of shops are obviously accepting more payments by card. And what a number of somewhat unscrupulous people have done is electronic sales suppressions, And that occurs when a business deliberately manipulates its electronic sales records to reduce or hide the value of its sales, while providing what looks like a compliant audit trail from sale to tax reporting. And there are a number of software packages on the dark web. Should you be tempted to use them, remember HMRC has ways of detecting them, and it has become an offence not only to use them, but also potentially to be, so if you make, supply, promote, or use ESS tools, that will give you a potential penalty on that basis. So again, it's been an area where HMRC has actually put in a disclosure facility on that and is looking to collect the tax on those types, where companies have used these types of arrangements and software. Another interesting case was about cash businesses, particularly restaurant businesses. Unannounced business found takings were higher than average, so HMRC argued suppressed takings. Owner argued that not representative Chinese New Year, and then Midsummer Payday. And the first-tier tax tribunal agreed that HMRC's assumptions were unreasonable. What was the point about that? Well, a reasoned defense. Don't expect that always HMRC will get it right. In this case, their sampling and their extrapolation was faulty because it was based on peak periods of business. And then another occasion where they made one visit undercover to a restaurant, paid a bit of cash, and did not take account of price increases over the years and did not listen to anything the owners said. And again, the appeal was allowed. Where it doesn't work very well for restaurants is if you get a number of revenue officers undercover buying a meal, paying cash with a bit of a tip, and then coming back 2 weeks later and finding that the cash has not been recorded on that basis. So at that point, I've reached the end at 12:01. Many thanks indeed. If you have any queries, please, you can ask via Quantumor, or my email address is up there, jpmind20@gmail.com. As has been said, the slides are available for you to download. And many thanks again to K3 Quantumor for hosting this session. I hope you found it interesting. Thank you very much indeed. Oh, a question? No, just thanks. Thank you very much.